Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
These are tough times, and they're getting even tougher. The clock is ticking. The countdown to collapse is well underway. What are you going to do about it? Will you just wait for it to happen, or will you be ready when it happens? The decision is yours, and yours alone. Join myself, Mickey Fulp, Robert Ian, David Morgan, Jeff Berwick, Elijah Johnson, Alan Butler, Gregory Manarino, Daniel Amaduri, Andy Hoffman, Tekoa Da Silva, Trace Mayer, one of the world's leading Bitcoin authorities, Bix Weir, Jay Taylor, and Gary Christensen at the Liberty Mastermind Symposium in Las Vegas on February 21st and 22nd, and learn how to create your plan to survive the collapse. The last Liberty Mastermind Symposium was one of the most highly rated conferences ever, and this one promises to be even better. Don't miss it. Join us and register now at libertymastermind.us. libertymastermind.us. This one is going to be out of this world, and it's going to be even better because it's in Las Vegas, Nevada. Go to Liberty Mastermind US and sign up today. You are listening to the FinancialSurvivalNetwork.com. I'm Kerry Lutz on 1230 WBZT. Are you ready for your unretirement? Well, you better get ready for it, because whatever you've got now, that's probably what you're going to wind up with. So rather than doubling down on riskier so-called investments, you better think about how you increase your income, your cash flow. For that, let's talk with Danielle Park. Danielle, how are you?
Hey, Happy New Year. I'm great, thanks.
Hey, Happy New Year to you too. And unretirement, that's an uncomfortable notion, isn't it?
Yeah, well, there was a new study out by Sun Life, actually. It was on the Canadian retirement pool of people and their present conditions and thinking, but it's really reflected in much of the Western world, and certainly in American data, because I watched that very closely as well. And it's just pointing out that, you know, in a zero interest rate environment, where people have been in a secular bear in stocks where they've had disappointing returns now for more than 15 years, and where yields are low and interest rates are pathetic, you just simply cannot, plug in your antiquated ideas about how much capital is needed to produce a reasonable retirement income today. The math that used to say 5% withdrawals a year were sustainable without impacting capital are just no longer applicable in this environment. And the reality is that withdrawal rates of around 2 are sort of a more sustainable plan. So when people do that math on their current savings, they typically come to two conclusions. One is they say, oh, well then what am I going to do? I need to increase my risk. And lots of financial advisors out there will say, yeah, all we got to do is buy you a bunch of, equity-based stuff, and we'll reach for yield and get you a higher payout. But I say that's a catastrophic approach for most people in this environment, at record valuations, in a secular bear, all that. And the much wiser approach is to say, wow, okay, so I can get, 2% a year in withdrawals from my savings. What can I do to supplement whatever else income I need? Is that continue to work longer, or is it get something simple and part-time, or is it do a little business on the side? Is it rent out one of my properties? Everything that you can think of in practical terms like that is going to be empowering and serve you much better than this sort of blind faith in, marketing concepts out of financial firms.
Hey, and one of the things that a lot of people do, at least in the States, they move from a higher tax jurisdiction to a lower tax jurisdiction, like from New York to Florida, or one of those places in the Northeast, place where they sell their home paying high real estate taxes in New York, move to a place with lower real estate taxes, or move to a rental property and cut their monthly costs dramatically that way as well.
I saw some stats on that recently, and that certainly is a massive trend. The people moving to Florida, like you did, are a huge majority of the movement of people around America right now, and I guess that's absolutely the reason, right? To get more net cash flow, and also I guess because in a more temperate climate you have less, maintenance of property, perhaps in terms of snow and land, and just the coats and tires and everything that come with many seasons. I guess is just a lower cost way of life in warmer climes.
Oh, yeah, no state income tax, much lower real estate taxes, lower sales tax. And even though Florida is not the lowest cost state by any stretch, you've got Texas, you've got Tennessee. And then also you've got a trend of people moving out of the country to lower cost countries as well, like Costa Rica, like Panama, and other such places. Again, where healthcare is much less costly as well. Someone was telling me they pay about $200 a month in Costa Rica for their health insurance, and that covers everything.
Yeah, I'm not aware of another time in history, and maybe there was one, right? I don't know of one where this kind of impetus has been behind mass migration. Typically, we've seen that during times of depression or deep recession in certain countries where people will leave to go find work somewhere. This is a different social force at work, right? This is prompting people to move not so much for work, which they really should be considering today if they can, but this is more for net cash flow in retirement to accentuate what you can buy, your purchasing power, and that's a reason a lot of these people are moving. So it's an interesting force. It will dictate things, for example, with respect to intergenerational contact, like between grandparents and kids and their grandchildren, right? Because if they're moving in their retirement far away for economic reasons, that's obviously a social impact.
Yeah, exactly. That makes a difference. I mean, for generations, parents have been moving down to Florida, but now out of the country certainly becomes an option. And yeah, no question about it. And medical care outside the U.S., outside Canada, has advanced dramatically over the past couple of decades. And things like medical tourism, trends like that, definitely accelerating. You see it all over the internet.
The other thing I think that's important, though, I was encouraged to see, that people are taking these more practical steps now, because it's been a long time they've been kind of in denial, or I guess hoping that the good old days of the late great secular bull when stocks were going up 20% a week in the late 90s. I guess people kept for a while hoping that would be the norm and that was returning anytime soon. But in fact, that hasn't been the norm for the last 15 years. Despite big rallies and recoveries, people have really just got back to what they lost and then seen their retirement savings plunge again, recover over 5 years and plunge again. And now here we are again at risk of another sort of plunge time. And I think that's really sobered people up. But it's good in a way because, as someone who's been aware of this secular cycle and the demographics and the issues and the living longer factor, again, people used to retire at 65 and be dead by the time they were 69, and now they're retiring. They were trying to retire at 55 and live till they were 90, and the math just doesn't work in that environment. So, as one of the people that's been trying to preach this stuff for the last 15 years, saying to people, listen, you got to think about working longer and supplementing income and doing other things. It's actually a very empowering thing to see people do this. I mean, they may see it as they're a victim, but in reality, it's more like they were victimized by the marketing mantras of the old days, where they were told that they could just have a life of leisure. All you needed was some savings, and you could, kick back and collect passive income for 30 years. I mean, I don't think that was ever actually a realistic assumption. But that's what, the Freedom 55 moniker, that was the whole stick. So anyway, I'm glad people have woken up, and the data seems pretty profound. Like since 2008, it used to be about 55% of Canadians expected to be fully retired at 65, and today it's less than half that. It's about 27% are saying they see themselves able to fully retire by that age. So again, I think it's all practical, part of the solution, part of working your way back. I'm really concerned that people don't just take the blue pill again from the financial community who tells them, oh no, just don't worry, be happy, take these high-risk stocks, hold them and go golfing. And I think they're going to find that that's a horrible advice again. So I'm just trying to caution as many people as possible.
And yet the public pensions haven't gotten that dose of reality yet. They're still programming in 8% compounded returns into their expected rate of return for their retirees. And as we saw in Detroit and countless other public pensions, they're underwater, and they continue to go more and more underwater. And that trend shows no signs of changing, especially after you have a couple of years like 2013 and 12, where they did get those returns after many years of subpar returns.
Yeah, so it's a little more complex, but I agree with you. The same math applies to retirement systems. And again, I've been pitching this to boards at retirement plans for many years now, just to say, guys, it's not realistic. You're not likely to achieve your goal. You're going to keep carrying forward this underfunding component that's going to just, balloon over time, and you're going to have to face the music at some point where you say, the answer is we have to increase contributions. Employers have to put in more, and certainly in the private sector, the companies have had record profits of late. So to the extent that they have employee contribution plans, defined benefit plans, and there's not that many of them left, but to the extent they do, part of the solution is going to be companies have to pay in more. They won't, they'll gripe about that because they'll say it'll hurt earnings and it's not good for shareholders. But at some point, if you've made a commitment to fund a thing, you have to fund it, right? And the same's going to go for the workers. They're going to probably have to take it later, take a bit less, and put in more contributions. But when it comes to an individual, there's just less flexibility that way because it's your lifespan, right? You're already whatever age you are. You already have whatever savings you have, and there's not a lot of other people that can bump it up, or you can't dollar cost average over younger people. It's your own individual savings. So you have to be extremely careful on your individual side, even more so than a pension plan. And then when you get to the public pensions, that's a whole other nightmare, right? Because they've been going up, they've been escalating they've been getting wage increases, they've given huge benefit increases, even while the rest of everyone else has been stagnant. So at some point, there's going to have to be some really tough calls there for sure.
Yeah, the sooner it happens, the better. But they don't seem too anxious to have that reality check, do they?
Well, you see that recent the plan or proposal that came out of your Senate yesterday or last night about increasing the just as an example, the long-term employment benefits, to put them forward another 3 months, right? To extend those programs that expired at the end of December, another emergency benefit scheme for another 3 months, and it seems like that's been agreed and is likely to go ahead. And I just shake my head because I get it. If you're desperate and you're about to go live on the street, obviously 3 more months of benefits help. But again, to what end? To where are they headed? What is the plan? Instead of just living on a line of credit a little longer, what is the plan? And humans typically need a massive awakening call or an end to a line of credit before they absolutely reinvent their habits and their approach to things. So I just think that I'm very torn about that because I really don't think the solution is keep extending unemployment benefits for months and months and years when people really have to reinvent or move or change completely their thinking and expectations these days.
Yeah, it's definitely a little bit scary, and they're not. There needs to be a paradigm shift, I guess, is what it is that has to be done, and they're not doing it. They're just not doing it. And
that old saying, necessity being the mother of invention, is truly the case, I think. You see it in health issues when people hit the wall and have some massive wake-up call, then they typically will say, oh, well, what do I need to do, And I liken my job as a financial analyst and advisor to real life people is very similar to a fitness consultant or a cardiac doctor who's telling people the truth. It's like you could continue in your old habits, and we could give you a bunch of drugs, and hopefully you'll get through. But you may not. You may crash in a dramatic fashion, or you could start walking and eating better, and we could probably take you off these drugs, and you could be self-sustaining. Which one would you like? And the thing goes with finance the same way. People can either believe what they want to hear or believe what everyone's selling them, or they can actually sober up and say, hey, how do we sort of be sustainable in this environment? Because this really challenging time with these record low rates and these really pathetic yields and extremely overvalued stocks, those are all going to shift eventually. This is not a permanent state. So the good news is, I think, another 3 to 5 years maximum before we get to much more conducive financial conditions, let's put it that way. But in the meantime, you have to be proactive now. Otherwise, you just keep making the problem worse.
Yeah, exactly. And speaking of not wanting to face reality and all that good stuff, what about the ECRI coming out, or apparently it's going to come out, with a finding that the U.S. might have been in a recession recently and is in a recession now?
Yeah, well, you see, they have actually been making that call since late 2012, and they've been, gone through a hell of a time because the data, as you know, the official data is simply not justified or confirmed their recession call. And they've actually got an excellent track record over time of following their proprietary metrics, and they take certain measurements on economic data, and they make a call about whether an economy is likely to recess. So they did do that in 2012, and then, of course, the data did not confirm it. And so he's been, the Lashman Nakhutan, who's the head spokesman for the ECRI, which is what it's called, the Economic Research Institute, is been, not seen much of on public airways. He hasn't been given much time. One, because nobody likes a recessionary call and everybody thinks it's a party pooper, right?
Yeah.
But secondly, because they've said, well, you were wrong, you were clearly wrong. And his point is always, guys, listen, first of all, we've changed the way we measure a bunch of these metrics, which is going to impact their comparables when you look at this cycle versus other cycles. But also, we typically revise these things significantly up to 2 and 3 years after the fact, and the revision range is typically 2 to 4%. So if you're talking to me about, the U.S. didn't recess in 13 and you were wrong because it averaged, 1.8% growth rate, a year or so from now, you could easily see a revision that knocks that right off and right into negative territory. And by then, who knows what's happened with, again, all these people that have been sitting around waiting for jobs to come back, or stock markets that are today forecasting rosier and rosier futures with no sign of a pullback. When any of that data comes to suggest that was all a facade or a mirage, and in fact the economy was a lot weaker than it was measured, then, that can be, again, an abrupt wake-up call for some of these financial markets.
Yeah, very abrupt. And, boy, will they be surprised, huh?
Well, they always are. They always are. Every economist and financial guru typically are inherently optimistic because, you know what? When you're pessimistic, nobody wants you around. It's, I think of a couple of the proposals that have come my way in the last few years, to do shows, for example, a proposal to be a regular guest on a show on CNBC in 2011, and I said, "Well, it sounds interesting. What is it?" Well, it's a focus on commodities, and we're going to talk about our hot tips and hot ideas about what to buy in the commodity space every day when we do the show. And I'm like, well, the problem is that the commodity cycle, in my opinion, already peaked in 2008 and rebounded into 11, and it's been falling ever since. And if you're telling people to be, giving them hot picks in the commodity space every other day, you're likely to be blowing their limbs off. So of course I didn't get that gig because nobody wanted to hear that. And not trying to give myself huge credit. It was pretty obvious. And indeed, things have been plummeting in that space ever since 2011. Canadian dollar, again, this week is below 81 on the FXC index, the Canadian dollar index. And it's a risk-on, risk-off currency, right? So risk-on, when the QE stuff started in 2009, Canadian dollar rallied hard out of the bottom of the recession, and everyone became uber optimistic that hopefully, more cash flow was going to solve the demand demise following the credit bubble bursting. So everyone piled into risk assets, piled into the Canadian dollar, and you saw it rally. But then when the economy turned down, when it was obvious that liquidity wasn't following through into the economy, but was piling up on bank balance sheets, and it was just a facade, then you saw the Canadian dollar start to trade lower again. And what I find really interesting, and again, I know this from experience, but I always find it fascinating in real time, is, again, there was a lot of people selling the Canada story along with the commodity story, and it was the greatest story ever sold from 2003 into 8, because you had China joining the World Trade Organization in 2001. You had the big demand cycle start, and it was fueled by the global credit bubble and the credit derivatives market, which poured gasoline over everything, and everyone was buying everything. So you get this huge run up. Then you get a spectacular peak collapse where all these, financial institutions burst basically from their leverage. And then what you have is so many people still long that story. In other words, so many funds and managers and gurus had got famous in the run-up, and they were all famous as those proponents of that particular area. So they just continued to tell that story. And even up until just recently, you've had a huge amount of bullish forecasts for things like the Canadian dollar. A lot of Canadian firms marketing to U.S. investors, saying, "Hey, Canada's the strong north, the true north, strong and free," and wrapping themselves in the flag. And in fact, it's been a very bad investment theme for Americans to come up and purchase anything. The Canadian market, the Canadian commodity story, the Canadian dollar. It's all been losing them tons of money the last couple of years. So. And just lately in the paper on the weekend, I saw, the consensus economists has apparently just recently turned to thinking there's more declines ahead for the Canadian dollar. I mean, what can you do with these guys, right? They're always telling you what's happening now, not what any reasonable sign of what's coming down the pipe. So in our own humble work, we have just been saying the Canadian dollar was tied to that commodities bubble, credit bubble, all that was one, and that it was likely to be declining now because the world is back in a slow growth phase, and Canada's domestic economy is heavily indebted. And so we see there's likely further downside. Our target all along on this has been about 85 on the Canadian dollar index. So we'll see. Today it's breaching the bottoms it hit in the support line from the 02 and 08 bottoms. And that's also usually a leading indicator for equity markets. So it's interesting. We had the resource sector come back to retest the 08, 09 lows, and we now have the Canadian dollar vying for that same distinction. And again, that should translate into significant downside risk for equities. It's been stalled and postponed a couple of times on belief in QE and magic, but I think it's coming back around again.
Well, Charles Nenner, who's a great cycle guy who called a lot of these cycles, and by the way, everything you said for the Canadian dollar has come true for the Australian dollar in spades. The Australian dollar, he says, the cycle has bottomed and is close to breaking out, but he says you only want to go long on a close above 90.30. And for the Canadian dollar, he said it finally reached the target of 108, and basically not going to see it reverse until there's a confirmation below 107.2. So he
thinks the Canadian dollar is going to rally from here.
Yeah, that's pretty much what he's saying.
So generally speaking, that would be someone who is believing that the growth cycle, for example, in China has bottomed. Typically, they correlate the Australian dollar with China. So they say, the Chinese economy has the Chinese stock market's down, 80% from where it peaked at the top of the credit bubble in 06. and they're saying, they think that the economy is now sort of solidifying and will start to regain and start to have more demand in the world, and that will be supportive of commodities again, supportive of Australian dollar. And then most people connect the Canadian dollar with the U.S. story more, right? So if they think the U.S. economy has bottomed and is starting to accelerate, they will be bullish of the Canadian dollar. But I guess I so far would have to say we disagree with both of those calls, and expect that we still are likely to see some disappointment in the growth cycles that are going to be apparent in 2014 for both of those economies.
Yeah, well, he's not so much tying to that. He's mainly just a cycle player, and he believes the cycle has bottomed for both the loonie and the Aussie dollar, and that it's time to reverse now. But whether he's right or wrong, I don't know the answer.
Right? We'll have to take our humble measurements and try and follow what's actually happening in the money flows.
Yeah, exactly. On the note for crude oil, he's saying he sees it going down as low as $80, but he's not always right either. So I wouldn't bet the house on it. It's been going a little crazy, and certainly crude going down to 80 does not bode well for the world economy either.
Or the Canadian dollar, typically.
Yeah.
But
or the Canadian economy.
We still are very rocks and trees orientated. We haven't made a lot of progress. Again, when the easy money comes, it tends to make people kind of, stay with the status quo. And we've had tons of easy money, certainly during the commodities boom. But in the last while, it's been slowing up. You saw our jobs report on Friday. Actually, our December jobs report contracted. So it was you had a disappointing American jobs report. Canada's was even worse. And we have Canadians more over-levered than the U.S. Households are today. So it's not going to be a very easy time for people to absorb slower growth and disappointing data.
That's for sure. Well, on that note, we got to get going, but jugglingdynamite.com, financialsurvivalnetwork.com. Of course, we always have a link in the show notes to your site, Danielle, and thanks so much for being on.
Hey, my pleasure, Kerry.
All right, we'll talk to you in a couple of weeks. Be well.
Oh, okay, sir. Bye-bye.
Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you. Our friend Tom Dyson at the Palm Beach Letter is giving away free copies of a really cool report he put together called How to Protect Yourself from America's New Secret Police. Inside, you'll learn all sorts of simple, everyday tricks you can use to make yourself a little less visible and vulnerable to scammers, hackers, and even the federal government. For instance, inside Tom's report, you'll learn which free internet email service never to use. This company doesn't care if your account gets hacked or not. 4 things the government must tell you if they request your social security number. And how to spot skimmers lying in wait on ATMs and gas pumps, and much, much more. These tricks and secrets are low-hanging fruit ideas. You don't have to invest time or much money into them. Most are free. But by taking some basic measures, you can make your privacy much harder to invade than your neighbors. Tom's report is available for a limited time to listeners who take a trial subscription to his newsletter. Just visit the Financial Survival Network homepage for more information, or go to www.palmbeach.com www.palmbeachletter2.com. That's www.palmbeachletter2.com.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.